A debt crisis does not begin when people panic. It begins when life still looks normal, paychecks still come in, stores still stay open, politicians still say things are under control. And right there, before the headline turns into fear, the middle class starts getting hit first. Most people only notice the crash after the damage is already done. If you want to hear how these patterns really work before they show up at your own front door, keep close to this channel, because what I'm about to walk through is the part most people miss. I have spent a lifetime studying debt, markets, governments, and the way human beings behave when money gets tight. The pattern is not random. It repeats. The names change, the dates change, the slogans change, but the pressure points stay remarkably similar. When I say the middle class gets hit first in a debt crisis, I am not saying the poor do not suffer. They do, and often in brutal ways. I am saying that the middle class is usually the first broad group to feel the squeeze in a way that starts changing the whole economy. They are the people with salaries, mortgages, car payments, retirement accounts, school costs, insurance bills, and just enough savings to think they have a cushion. That mix makes them look stable right up until the system turns against them. A debt crisis, at its core, is very simple. It happens when there are more promises to pay money than there is income and cash to make good on those promises. Debt is a promise, a bond is a promise, a pension is a promise. Even a savings account depends on a broader system of promises. When too many promises pile up on top of too little real earning power, something has to give. Most people think a debt crisis is about a government owing a big number or about a scary day in the stock market. That is too shallow. The real issue is the relationship between debt income and interest rates. Interest is the cost of carrying debt. If debt grows faster than income and interest rates rise or stay high, the math starts breaking people before it breaks headlines. That is why I always watch cash flow before I watch emotion. I have studied debt cycles going back hundreds of years. In the short cycle, central banks lower interest rates when things weaken, and that helps people borrow and spend again. But when they do that again and again over decades, debt keeps building faster than the system's ability to support it. Eventually, rates are already low, debt is already high, and there is not much room left. That is when the long cycle turns. That is when the hidden weakness becomes visible. The middle class sits right in the middle of that machine. The rich usually own more productive assets. By that I mean businesses, stocks, real estate, and other things that can rise with inflation or even benefit from policy rescue. The poor often have very little cushion, but they may receive more direct support when the pain gets obvious. The middle class is different. They own some assets, but often not enough. They carry debt, but not enough power to reshape the terms. They earn too much to be protected quickly and too little to be insulated. That is why I say they get hit first. They get hit through the cost of money. They get hit through the value of money. They get hit through their job market. They get hit through taxes. And they get hit through the false comfort of believing that because the number in the bank account still looks the same, the value is still there. In a debt crisis, that illusion can last longer than people expect and then vanish faster than they imagined. Think about a normal family doing what society told them was responsible. They work hard. They buy a house with a mortgage. A mortgage is a long loan tied to a home. They save into retirement accounts. They keep some cash in the bank. They do not own a private equity firm or a gold mine. They do not have a team of lawyers and tax experts. They are not looking for luxury. They are just trying to preserve a standard of living they already earned. Now put that family inside a debt crisis. At first, nothing dramatic happens. Their grocery bill rises. Their insurance bill rises. Their rent or mortgage feels heavier. Their wage does not keep up. A raise comes in, but it feels smaller than the price changes around them. Then credit gets tighter. Credit means borrowed money. The bank that used to call them with easy offers starts asking harder questions. Suddenly, the family that looked stable starts feeling fragile. So I want you to sit with one question as I go deeper. If your income stopped rising for a year, but your costs kept climbing, how long would your current plan still feel safe? Most people do not ask that question when times look calm. They ask it when the answer is already painful. By then, what looked like a personal problem is often a system problem that is spreading through millions of households at the same time. The first way the middle class gets hit is through interest rates. When inflation rises, central banks often raise rates to slow spending and borrowing. That sounds technical, but the real life effect is simple. Mortgages get more expensive, car loans get more expensive, credit card balances get more expensive, small business loans get more expensive. The middle class lives in that lane more than the rich do because it uses financing to bridge the gap between income today and goals tomorrow. Then comes the second hit, and this one is even more misunderstood. If the debt burden gets too large, governments and central banks often choose some form of money printing and currency devaluation. Money printing means creating more money and credit to keep the system from cracking. Devaluation means the currency buys less. It does not always look dramatic. Sometimes your account balance stays the same or even rises, but what that money can buy keeps shrinking. That quiet theft falls hard on savers. The rich are often faster to adjust because they hold assets that can rise with inflation. The poor, when the crisis becomes political, may receive direct aid, subsidies, rent support, food support, or debt relief. The middle class is left in the awkward middle. Its savings are usually too large to ignore and too small to protect. Its labor income is taxed and exposed. Its cost of living rises. Its portfolio is often concentrated in homes, retirement funds, and cash. That is not a fortress in a debt crisis. It is a pressure box. The numbers tell a story that is bigger than one recession. In the United States, the share of people living in middle-class households was about 61% in 1971. By 2023, it had fallen to 51%. That may sound like a slow change, but it is huge. It means the broad center of society has been thinning out for decades. That is not just a cultural feeling. It is an economic shift that changes how resilient a country is when debt pressure rises. Income tells the same story. Middle-class household income did rise over time, but it rose much more slowly than upper-income households. From 1970 to 2022, the median income of middle-class households rose about 60% after adjusting for inflation. Upper-income households rose about 78%. That gap matters because debt systems depend on broad earning power. When the center of the income base grows more slowly than the top, the economy starts leaning harder on credit to maintain demand. And then there is the share of total income. In 1970, the middle class held about 62% of total household income in the United States. By 2022, that share had fallen to 43%. Over the same period, the share going to upper income households rose from 29% to 48%. That is not just inequality in an abstract sense. It means the broad group that spends, borrows, buys homes, raises children, and supports local economies has less of the pie, while the debt structure built around them has not become any kinder. When I talk about a hollowing out of the middle class, I am not speaking in slogans. I mean that the center becomes less able to absorb shocks. One recent study found that about 1/3 of the American middle class could not afford basic necessities where they live. Basic necessities means housing, food, childcare, healthcare, transportation, and taxes. Think about that. A group called the middle class in one of the richest countries on earth, and 1/3 of it is already straining just to cover the basics. That is what late cycle stress looks like before the full storm arrives. Debt itself is now enormous. Total household debt in the United States has climbed to around $18.8 trillion. That includes mortgages, auto loans, student loans, credit cards, and more. Numbers that big can make people numb, so I always bring it back to behavior. Big debt means more households are sensitive to rates, job loss, and tighter lending. It means a change in policy hits faster. It means the margin for error gets thin. And when the margin for error gets thin, the middle class feels it before the headlines say crisis. There is another layer people miss. inflation does not hit every household the same way. Lower income households often spend a larger share of their money on rent, food, and medical care, and those essentials can rise faster. But the middle class gets trapped in a different way. It often has larger fixed commitments like mortgages, cars, college savings, and insurance, while still depending heavily on wages. So even if headline inflation cools, lived inflation can keep biting. Your real life does not care what the average says if your personal basket keeps rising. And if this is making you rethink what safety really means, ask yourself something simple. Is your financial life built to survive higher rates, weaker money, and slower growth at the same time? Or is it built for the world we all got used to when money was cheap? That question matters more than whether the next headline sounds good or bad. Debt crises punish outdated assumptions long before they punish outdated opinions. People also misunderstand the order of events. They think the first sign of danger is default. Default means a borrower cannot pay as promised. But before outright default comes a long stretch of tightening. Banks reduce risk. Employers slow hiring. Small businesses pull back. Home sales freeze. Consumers stop upgrading and start postponing. The middle class feels this first because it is the part of society most tied to the normal flow of financing. When that flow slows, the center of the economy starts losing oxygen. I saw this clearly in 2008. What collapsed in public memory was banking. What cracked in daily life was the middle class balance sheet. Home values fell, home equity lines vanished, retirement accounts dropped, job security broke. People who thought they were building wealth through a house discovered that much of that wealth had been financed by cheap credit and rising prices, not durable cash flow. The result was not just a recession, it was a deep hit to confidence, family planning, and trust in the system. History gives us even older examples. In 1933, the United States broke the dollar's old gold link at home. In 1971, it broke the remaining link internationally. Those were forms of devaluation. They were ways of changing the rules because the old promises had become too hard to keep. Most people did not frame it that way. They just lived through the consequences. That is how debt crises often work. The policy language sounds abstract, but the lived outcome is simple. The currency buys less, the rules shift, and ordinary savers pay. Japan offers another lesson. After its great asset bubble burst around 1990, it spent years keeping weak parts of the system alive instead of cleaning them up quickly. That created what many call zombie institutions. Zombie means they are alive enough to exist, but too weak to grow. For regular people, the result was long stagnation, not one dramatic collapse, but many years of low energy, weak growth, and limited opportunity. That is another way debt crises hurt the middle class first. They turn the future from a ladder into a hallway. Now, a fair objection always comes up. Some people say, surely the poorest are hit first, not the middle class. I understand that point, and in terms of raw pain, the poor often suffer the most, but that is not the same as where the crisis first spreads through the core of the system. The middle class is the transmission belt. It is the tax base, the home buyer base, the consumer base, the borrower base, the small investor base. When that group starts retrenching, the whole economy changes shape. There is also a policy reason the middle class gets hit early. Governments react politically, not just economically. At first, they try to protect markets, banks, and system stability. Later, when the pain becomes visible, they try to protect the very poor to avoid social breakdown. The middle class often waits in line between those two priorities. It is expected to be resilient. It is expected to keep paying. It is expected to adjust. That expectation becomes a form of silent taxation in bad times. Over the last few decades, technology and globalization have added pressure to this. Cheaper imports lowered some prices, but they also hollowed out many jobs. Automation made some workers far more productive, but it also made other workers less necessary. The gains from those changes did not flow evenly. Asset owners gained a great deal. High-skilled workers often gained. Many ordinary families did not. That widening gap matters in a debt cycle because weak income growth in the center often gets papered over with more borrowing. Credit fills the hole until it cannot. So when I talk about debt, I am never talking only about bond markets and budgets. I am talking about social order. A debt crisis is a money event, but it quickly becomes a class event, a political event, and sometimes even a moral event. People start asking who got bailed out, who paid, who benefited from the boom, and who was told to be patient. Those questions do not appear at the end of the cycle. They build all the way through it. And the middle class usually feels the tension before it has words for it. I would pause here and ask you to examine one belief. Do you still assume that working hard and saving in the national currency is enough to protect your standard of living, no matter what governments and central banks have to do next? Many decent people believe that because it used to be closer to true. In a late debt cycle, it becomes less true. Effort still matters. Discipline still matters. But understanding the system starts mattering much more. There is a bigger layer above all of this, and that is the role of global confidence. Countries with reserve currencies have more room than others. A reserve currency is a currency the world uses widely for trade, savings, and debt. The United States has had that advantage for a long time. It can borrow more cheaply and for longer than most nations. That is a great privilege, but it is not magic. If debt keeps rising faster than the system's productive power, even a reserve currency country reaches a point where investors start demanding higher compensation for the risk. That is where the debt spiral can become dangerous. The government borrows more, interest costs rise. Then the government has to borrow even more just to pay interest. If enough investors start worrying that the debt will be inflated away, they ask for higher yields. Yield means the return they demand to lend. Higher yields raise borrowing costs across the system. That pulls more money away from productive activity and into debt service. When that happens, the middle class feels it through taxes, rates, and weaker purchasing power all at once. Some people say, fine, but central banks can always print. Yes, they can print. And most of the time, eventually, they do. But printing does not remove the burden. It changes who pays. Instead of a clear default, you often get a hidden one through inflation and devaluation. The bond gets paid, but the money is worth less. The account still shows dollars, but the dollars buy less. That is why I say debt crises are often resolved in ways that look less dramatic on paper than they feel in life. Institutional behavior matters here. When experienced investors sense that debt and money printing are likely to dominate the next phase, they start shifting. They do not wait for perfect certainty. They move towards scarce assets, productive businesses, stronger balance sheets, and sometimes gold. Gold does not produce cash flow, but it has long served as a hedge when trust in money weakens. Meanwhile, ordinary households often do the opposite. They cling to the assets they know, the savings format they trust, and the assumptions that worked in the previous cycle. That gap in behavior is part of why the middle class gets hit first. Smart money is looking ahead. Ordinary life is looking around. There is nothing foolish about that. People are busy raising children, paying bills, and doing their jobs. But in a debt crisis, delay is costly. By the time the broad public feels the need to reposition, prices have moved, rates have changed, and policymakers have already shown their hand. The advantage goes to the people who understood the mechanism early, not the people who reacted emotionally late. There are several ways this can unfold from here. One path is a relatively orderly inflationary deleveraging. Deleveraging means reducing debt burdens over time. In plain English, it means policymakers try to keep growth just high enough and inflation just warm enough so the debt becomes easier to carry relative to income. That path can avoid a brutal collapse, but it still tends to hurt savers and wage earners if their assets and incomes do not keep up. It is gentler than a crash, but it is not painless. Another path is stagflation. Stagflation means weak growth mixed with stubborn inflation. It is one of the hardest environments for the middle class because wages lag, borrowing costs stay annoying, and asset prices do not always provide clean relief. In that world, people work just as hard and feel like they are moving backward. Taxes may rise, services may weaken. Public frustration grows because the economy does not clearly crash, but ordinary life keeps getting tighter. It is the slow boil version of a debt crisis. A third path is a sharper break. That could come from a bond market revolt, a geopolitical shock, a banking accident, or a policy error that destroys confidence quickly. In that case, the sequence gets faster. Credit tightens more abruptly. Asset prices reprice. Emergency measures appear. Politicians talk about stability while rewriting rules. That is the ugly version. It is not guaranteed, and I do not spend my life predicting exact dates. But anyone studying debt cycles has to respect that possibility because history is full of moments when confidence changed much faster than the public expected. So what should an ordinary person actually do with this? I start with a simple principle. Do not confuse nominal wealth with real wealth. Nominal means the number printed on the statement. Real means what it can actually buy and how resilient it is under stress. A rising account balance does not help much if your currency is weakening, your taxes are rising, and your cost of living is outrunning your income. In debt crises, real thinking beats impressive-looking numbers. I would also look honestly at debt. Not all debt is bad. Debt used carefully can be sensible, but debt that depends on perfect conditions is dangerous. If your financial life only works when rates stay low, your job stays secure, your house price keeps rising, and inflation cools on command, that is not a strong structure. That is a fragile structure that has not been tested yet. The middle class often discovers fragility the hard way because it has just enough leverage to amplify stress. And while you are listening to this, ask yourself another question. If the value of money keeps changing, do you own things that can defend your purchasing power, or do you mainly own promises from other people and institutions? That is not a cynical question. It is a practical one. In every debt cycle, the difference between assets and promises becomes clearer as the pressure rises. One tends to reprice, the other tends to disappoint. I believe in diversification for that reason. Diversification means not betting everything on one outcome. Different kinds of cash, different asset classes, different geographies when practical, and a careful mix of liquidity and protection all matter. Liquidity means money you can access quickly. In hard times, liquidity is not exciting, but it is freedom. It gives you time. It keeps you from selling good assets at bad prices. It keeps temporary pressure from turning into permanent damage. I would also focus on the durability of my income. In a debt crisis, employment risk is not evenly spread. Jobs tied to easy financing, high speculation, or discretionary spending can turn quickly. Skills that remain useful across different environments become more valuable. So people should not think only like investors. They should think like builders of resilient personal systems. Your income stream, your flexibility, your ability to adapt, and your community ties matter as much as your portfolio when the cycle turns. One of the biggest mistakes I see is chasing return when the real need is resilience. People feel behind, so they take more risk at exactly the wrong time. They buy the hottest thing because they think they need to catch up. They reach for yield without understanding the credit risk. They use leverage because someone else made it look easy. That behavior is very human, and it gets stronger late in cycles because the gap between what people have and what they think they need feels unbearable. But late cycle greed often hides late cycle desperation. I try to stay calm because cycles are emotional, and emotional people make expensive decisions. Fear makes people sell the wrong things at the wrong time. Euphoria makes them buy the wrong things at the wrong time. Debt crises punish both. The best defense is not brilliance. It is clear thinking, humility, and respect for history. I do not need to know the exact headline that will trigger the next phase. I only need to know the conditions that make a system vulnerable and the ways governments usually respond. There is also a moral lesson in this, and I do not mean that in a preachy way. A healthy society needs a strong middle class because the middle class is where long-term trust lives. It is where families believe effort leads somewhere. It is where local business, civic life, savings habits, and social stability reinforce each other. When debt cycles and policy choices keep weakening that group, the damage is not only economic, the damage is cultural. People stop believing the rules are fair. Once that happens, politics becomes much more extreme. That is why I do not view debt crises as isolated finance stories. They are tests of a whole system. They test whether leaders will tell the truth about trade-offs. They test whether central banks can balance stability with credibility. They test whether investors can distinguish paper gains from lasting wealth. And they test whether ordinary people can adapt before the squeeze becomes severe. The middle class is at the center of all of that because it sits exactly where policy, labor, housing, credit, and savings all meet. If this way of thinking is helping you see your own situation more clearly, keep coming back to these conversations because most people will only talk about the surface. They will argue about one election, one rate cut, one market drop, one monthly inflation print. I am more interested in the machine underneath. Once you see the machine, the headlines become easier to place. They may still surprise you in timing, but they stop controlling your thinking. I do not say any of this to scare people. I say it because patterns are useful only if they help us prepare. The middle class gets hit first in a debt crisis because it is the broad group most exposed to all the channels of pressure at once. It depends on wages, it carries debt, it saves in financial claims, it pays taxes, it lacks the cushion of the rich, and often lacks the immediate support given to the poor. That combination makes it the earliest large pressure point in the system. So when you hear people say everything is fine because the market is up, or because unemployment is still low, or because the government can always step in, remember this. Late cycle systems often look functional right until the center starts losing its footing. The warning is not always a dramatic crash. Sometimes the warning is a family that can no longer save. Sometimes it is a worker who got a raise and still fell behind. Sometimes it is a household that owns more on paper and feels poorer in real life. I have seen this enough times to know that what matters most is not the noise of the day. What matters is whether the promises in the system are growing faster than the real ability to honor them. If they are, then pressure will move somewhere. And because the middle class is the bridge between the whole system's promises and the whole system's spending, that pressure tends to land there first. That is not ideology, it is mechanics. If I were leaving you with one practical takeaway, it would be this. Build your life around real resilience, not around the hope that the old cheap money world is coming back exactly as it was. Reduce fragile debt where you can. Own some assets that do not rely on perfect trust in paper money. Keep enough liquidity to buy time. Strengthen the durability of your income. And judge your progress by purchasing power and flexibility, not by the size of a number on a screen. Because in the end, debt crises do not destroy people all at once. They test them in layers, first through prices, then through rates, then through jobs, then through politics, then through confidence. By the time the crowd sees the whole picture, the middle class has usually been living inside it for a long time already. That is why I pay attention to the squeeze before I pay attention to the panic. Panic is loud, but the squeeze is what tells me where the truth is. And the sharpest truth in a debt crisis is this. The first thing to break is rarely the headline. It is the quiet confidence of the middle class.